Welcome to Market Matters presented by MyX. I'm Joe T. Gay. With me, as always, is Brian Stutland. How's it going, Brian?
Great, Joe. Great. Good start to the week here for the markets. They're moving quickly here, so we got a lot to report about. How are things back with you?
Things are going great. I'm so glad that the winter break is over so I can finally get a rest.
Yeah, right. Exactly. Right. Sometimes that winter break can be quite hectic if you got kids running around all the time with you.
Yeah, so as you mentioned, it's a rough start to the year last week. Getting hit in the Nasdaq today or the Dow today by Boeing. Nasdaq's having a great day today. Apple leading the way. So let's get into it. We got a lot to talk about this week. We got, of course, we got some major economic reports. This is going to be crucial. CPI, PPI. That will be some market movers. It will be interesting to see how the market's going to handle that. How the expectations are going to shift. We'll get into the market expectations later in the show. We got some really key insights there. Of course, we have earnings coming up. This is the start of the earnings calendar. We got the banks coming up on Friday. We're going to get some movement there. We're talking about interest rates. The banks are critical to all that. Brian, you got a trade on JP Morgan later today. Stick around for that. You guys don't want to miss it. Now, we want to talk. We show this every week. This is kind of a investor sentiment survey. This is really something that I look to. Are we too bullish? Are we too bearish? It's very interesting. Look back, the high of the market right there, the last week of December, we got this 52-week high. So is that going to be something we'll be looking back to a few months from now, saying, whoa, there was a sign, people were way offside there, or will it just be another indicator? Let's go into the big story. Now, of course, we got past the jobs number last week, which was, okay, good enough. The market really liked it. The headline number was really good. Kind of confusing on the bottom line. There was some weakness out there. We had things like revisions and were bad and people working two jobs. But one thing that's kind of going under the radar is job openings. Something's out of whack here right now. The job openings are drying up. Nobody's listing new jobs. However, the S&P 500, which usually tracks this index pretty well, something's not out of whack. S&P 500 still close to all-time highs. This index is falling out of whack, and really, it's kind of a sign of like the expectations of what the Fed says they're going to do for interest rates and what the market says we're going to do for interest rates.
And a lot of chatter out there when you look at the jobs picture and what's going on there. A lot of creation being done inside government jobs, healthcare industry. So I'm not necessarily sure that's so healthy for the economy, and that's probably why you're seeing the spread in job openings versus the unemployment rate kind of staying tight. To me, it's somewhat manufactured, but we'll see how that plays out in the next couple of months.
Somewhat manufactured, but we'll talk about how the government and they have their foot on the scale, and they might continue to do so throughout the rest of this year. Speaking of which is the interest rates of the Fed. The Fed is going to be setting. Now, the market is expecting we're 6 or 7 cuts this year. That's a lot of cuts to be coming in now. The jobs market was. There were some signs of weakness over it, but you wouldn't have called it a disastrous number by any means. And usually you'd have a really weak economy with really high unemployment rate when you're seeing 6 or 7 cuts in a year. So there's actually a difference, though. The Fed actually saying, the economy is kind of strong. We're not going to be cutting 6 or 7 times. We're going to be cutting 1 or 2 times. This is the Fed dot plot. Look here in the middle here. This is 2024. Their expectations are really, between 4.5 and 5 is where the Fed's saying interest rates are going to be. So there's a big difference. Last year we saw this difference too when it kind of came back in line. We saw some movement in the market. When we saw that 10-year go up over 5%, we saw the market respond to that. So if the market does move back to the Fed, we might get a reaction there. So we'll have to wait and be patient on that. Now,
and it's interesting. It's interesting to see there, Joe, when you're looking at where the Fed has been and what people are expecting, let's say 2 years out on interest rates. One thing we've done for clients and for ourselves is looking more. It's crazy that bank CDs are actually paying more because they're trading at a slight premium to the Fed rate, and they're trading even higher than what you'd go 2 years out. So to me, it's a safe play there. It protects your money. Obviously, They're government insured type plays, and that's probably the highest yield in the marketplace. So if you're looking for sort of a safe money play, 6 month, 1 year, 1.5 year CDs is sort of a small little calendar roll has really been the play over the last year and a half or so. And I think we continue to sort of play that with our clients. And so that's been the play because the Fed has tried to follow the market, but really the market is wanting interest rates to cut more. And the Fed hasn't been able to do that. Why? Because inflation still remains above 3%, above that 2% target.
Now, one other tool the Fed has, which kind of goes underlooked, but it's actually a very important to how the market moves. Now, Brian, we know this, we talk about it all the time, is they're easing and they're tightening. We've been in a quantitative tightening mode lately, but that's actually kind of unusual. Usually the Fed has been easing. And Brian, I just look at this chart and I kind of shake my head. And this is the money supply. This is the amount of money circulating in the U.S. Economy, and this is what the Fed can kind of add or take off from. And I just shake my head looking at this chart because it's just starting to look parabolic. It's just starting to look like it just wants to curl up and up and up and keep on going. And Moody's recently downgraded the U.S. Debt because essentially this is one way we're paying off our debt by just printing more money, printing and printing and printing. We just passed a budget this weekend without any signs of, hey, maybe we should talk about cutting something, or maybe we should trim this $1.6 trillion budget. So our politicians have no interest in cutting our budget anytime soon, and the Fed is showing no signs of really any political will to kind of slow the economy down, to slow this down. So this is something to kind of shake my head out. Maybe I'm just going to jump on with it and say this is what it is and kind of figure it out. But just looking at it, I'm not sure long term how sustainable this is.
Yeah, I mean, when you see the money supply, obviously it jumped in the COVID era. We printed a ton of money sort of to deal with that issue, and now it's kind of coming back to that trend line. But that trend line has been on, like you said, this upward projection that is sustainable. It's a scary thought. The fact that we can't get our budget under control. The only way we're doing that is paying off debt by printing more money. This tailspin has to have some sort of consequence at some point. Does it happen this year? I don't know, but certainly this is something that definitely in the back of my mind worries me about the U.S. dollar, about what our government's trying to do and push forward. So hopefully we can maybe get some government cuts, get some spending under control here in the next few years. But obviously with such the wide divide in political views in the system right now, it's making it very tough to do.
Now, on my point, just jumping on board with this, one thing that also increases like this is the stock market, because of course the stock market is filled up with corporations. They're participating in this inflation. They're going to be selling goods higher. They're going to be taking advantage of all this inflation. The stock market also is moving up like this, but there are times historically though when the stock market's kind of overpriced based on the money supply versus underpriced. So this is another tool that we kind of look at here. We can go back historically and see, there are times where clearly in '99 we were getting in bubble territory where the stock market was way overvalued compared to the amount of money in circulation. But you can see as the market goes higher, as the money supply goes higher, also goes the stock market. But there are times when just the ratio just got out of whack. It's a sign, hey, things are a little more risky now than they otherwise would be. When this number is lower, it's a much more attractive time to be getting into equities. Another way of saying you're looking for a lower PE ratio, but a lower PE ratio given the amount of money supply, certainly. And yeah, just looking at that, there are times when things can be more risky. Now, am I saying we cannot do another 99? I brought up the possibility last week that if the Fed decides to cut a little bit early, and the economy is not really cooled off, that's certainly possible. Maybe we'll see another round of inflation. So, but just all things considered, looking back at the chart, it looks like we're on the higher end of the range.
Yeah, valuations are a little bit high. Two things have to happen. One, the money supply has to increase to sort of meet that level of market capitalization of stocks relative to the money supply. Or two, stocks have to correct themselves to come back down. But our thinking, Joe, probably is that heading into an election year, the Fed keeps up the money supply feature here to get valuations in place, to give justification to the stock market. How would you play this market if that's the case? If the money supply is going to stay increased if inflation is going to stay maybe on the higher end of things, of that higher than that 2% level? How do you play this?
Yeah, I mean, well, given that, stocks are maybe on the higher end of their range, but we are expecting the money side will go higher. Well, just take a look at this chart. I got the money supply. Again, if you look at this, looks parabolic to me, not just commenting, but you also just look at the spot gold. Now, they're not making any more gold. The amount of gold that has been made, I guess very slowly it's being made underground, or it's being brought up to the surface anyways. But they're not making any more gold. We're pulling some out of the ground at a very slow rate, but the price of gold is predictably going up with the money supply. It's a little bit out of whack right now. Have not seen this gold spike up with this COVID section of money supply increase. I think that's going to happen. I think that we're close to that, and I actually want to get into that in our trades of the day, Brian.
Yeah, I mean, you look at that, it seems like there's a little bit of catch up to be due. And so our trade of the day is a way to play gold here. And Joe's got that for you. He'll break it down how you plan it.
Yeah, just looking. This is just a 5-year chart of gold, bringing it a little bit closer in here. This looks like looked like a double top maybe, or trying to break out of this resistance area. This to me looks like a head and shoulders bottoming formation here. I think there's potential to break out here, and this is the GLD. That's a ETF that tracks the gold futures. I think this 190 area is going to be an area where if we break above it, there could be significant headwinds or significant tailwinds just to propel it a lot higher. And this is just going to be an inflation play for me, just protecting my portfolio against inflation. I'm going to buy a leap looking at the June 2025 190 call for $19. Going to spend about 3% of my portfolio to do that. I'll have inflation protection, and I think that 3% can turn easily into 6 or 9%, just with a modest increase or just a realization of that upside down head and shoulders.
Yeah, I think this is interesting because when you got the leap, there's obviously, when you're using those kinds of options, there's not as much decay value in the premium of those options. So there's sort of time for this sort of trade to play out and work for you. And so Joe's taking 3% of his portfolio, saying, I'm going to use 3% of the premium of my portfolio, use this as an inflation protection on the portfolio. To me, it seems like a great play because, like you said, above that 190, we probably get some explosion to the upside. If it tends to trend back down into that lower end of the channel, probably due to higher interest rates, that would sort of crimp on the money supply sort of issue here. There would be time to sort of sell out of this call, not necessarily hold this call all the way to expiration. So at least you're not losing all 3% that you'd outlay. So to me, I look at this as once this call probably gets down to less than 1% or around that 1% value, or the option price is lost. So let's say half or 2/3 of its premium, I'd probably sell out of this option and look for a different trade, not just watch this thing go to zero.
That's a good call. Now, another trade idea. We talked about this earlier. We got earnings coming up this week. Brian, what do you see in JP Morgan?
Yeah, the banks have been really on fire, specifically JP Morgan. Look at that chart. Basically exploding in the back half of this year to the upside. And as soon as the 10-year looked like it wasn't going to get and stay above 5% and started coming down, we saw JP Morgan really take off. And, we hold this portfolio for clients. I like the stock in general because it's such a big weighting as part of the bank financial sector here. And they really have been the leaders on money center issues here and that sort of part of the industry. And they've really been leaders in that in terms of the rest of the marketplace. So this is a stock that we like relative to the rest of the money center banks here. It's had a great run, but really it's now trading at the top end of the channel, and earnings are coming up this Friday. When I look at the earnings report, I look back and I see over the last, let's call it 3 or 4 years, only 10% of those earnings timeframes have seen greater than 6% move. So even though earnings is a big event, typically for JP Morgan, it's not that big of a money mover or market mover in terms of the price action of the stock. Although we've seen one move down of 6% after earnings. We've seen one of 7% to the upside in the last few years, but that's been it. The rest is really a tight range. And now we're trading at the top end of the channel. So one trade I like to do when I look at JP Morgan here is maybe the valuation's getting a little higher here. Normally, heading into an earning, I don't like to sell a call because we can get a great earnings forecast, and all of a sudden you've blown through the strike and you've given up all your upside. But the fact that the stock is at the top end of the channel here, I'm looking to sell this Friday option expiring. So the earnings come out Friday morning. This option will expire by the close on Friday in the afternoon. And it's the Jan 172.5 call. I'm going to want to sell that for about $1.50. So you're looking at almost capturing 1% premium. And I'm just doing this because I'm pretty confident we don't get through the 172.5 strike move. That would be more than about a 3% move to the upside based on where the stock is trading now. Plus, it would sort of gap through that upper end of the channel. So I'm looking just to take in some premium, take some profit on the great run that it has. And, if it pulls back, I'm going to continue to own this stock anyways in my portfolio. So this is just an extra way to sort of add extra premium to my position.
Yeah, it seems like a good spot. You're kind of just saying, I'd like to sell at the top of this channel, which we have reached. Just take some off the table here. That is very prudent to me. There's risk, not a lot of upside gap risk to me here. Now, if it does happen, that's fine. You're collecting your premiums. You're still happy with that, but you're going to be way better off if we do pull off just slightly.
Yeah, and if again, this option expires this Friday, so if it blows through 172.5, I have to be either willing to get short the stock if I don't own it, or if I am long it, I'd get called away. So watch that on Friday. Pay attention to what the earnings look like, where the stock moves, because you're going to have to make some sort of positional adjustment if the stock gaps higher. But in my case, I'm willing to get called away. We're long the stock, but I'm willing to get called away on some of it if it were to move higher.
Is there a price you'd buy it back before earnings? Maybe get.
Well, yeah, I mean, the CPI reports on Thursday, right? So that could be a market moving event. If that sort of comes in, inflation a little bit higher than expectation, we could see interest rates move higher. We could see the market sell off a little bit. That might be a time where I actually do close the trade before Friday, because those option premiums will probably, come off pretty hard at that point.
All right, let's move it forward to the question of the day. Reminding everybody to send us your questions ahead of hand. If you like what you see here, ask us on YouTube, on Twitter, on LinkedIn. Like, comment, share, tell your friends, tell your wives, tell your mother, tell your brother. Brian, you got any question for me?
Well, as you can see, I'm more casual today because we got game day right now. Once the market closes, I'll probably be more in the, tailgating pre-party mode. My Michigan Wolverines heading into the national championship, trying to win a undisputed national championship for the first time in over 50 years. Obviously, we won it in a share of it in the 97 era of my time, my last year in school. But Joe, us traders, we're traders on the floor. We could bet on anything, right? If we could bet on, how many chicken nuggets somebody's going to eat in over under in 30 minutes, right? You and I have experienced that firsthand with other traders on the floor of the SIBO. So there's a market on Michigan. The line came out at about 4.5 points, Michigan favorite. So it's moved either way depending on what betting sites you use. You're not a Michigan. You are a Michigan person, but didn't go to school there. So I'm going to get your unbiased opinion. You know who I'm picking. What do you think? Based on that line, who you betting on?
Yeah, I mean, I'm a Michigan State person, so there might be some bias in there. But I think I'm going to take Michigan and lay the points. I think this Harbaugh redemption tour is going to come full circle, and it's going to be a happy ending there. Although, typical Michigan fashion, just like in '97 when they couldn't have their own national championship, people after the fact are going to dispute this one because of the allegations that happened earlier on in the season.
Yeah, well, we'll see, but I like it. Let's hope they pull through. I know normally we give you an extra trade on the day or a question about something about the market, so please write in. That's one of our specialties here. We have some good answers for that. You can live interact with us, and we'll get some more color on the stock market. But obviously, a big day for my Wolverines right now, so I'm focused on that.
All right, now the moment you've all been waiting for. This is a big one. Options 101. How do you use the spike index as a tool?
Yeah, so the spikes index measures volatility or premium of options basically on the broader market, because the spikes index is based off the SPY ETF. And historically, this tends to trend between 10 and 20. That means options are priced fairly normal across the marketplace. Obviously, there's some specific issues with individual names, but the broad market says prices are priced fairly. If the spikes trades more towards 10, it means option prices are cheap historically relative. If it's above 20, then usually there's some sort of market event that causes some big volatility move and option prices increase in value. So this is a good gauge for me to determine whether I'm a buyer or seller of options. But Joe, do you use the spikes at all to trade the market other than looking at option premium?
It is a market indicator for me, and as Warren Buffett said, be greedy when others are fearful. So when the spike index is high, it's time to buy.
There you go. That's our Options 101 play of the day. And that basically concludes our show here. Our show's put on by the Tradier Hub, sponsored by the MyX Exchange. Joe Teague, myself, Brian Stutland here at Equity Armor Investments, bringing you Market Matters every week, every Monday. Please tune in. We've made some great calls on some of our trades. We give some good color about sentiment in the market and what directions we're heading in the week to come.
Have a good week.